Welcome back, everyone. Next, we have VivoPower PLC, trades on the NASDAQ under the symbol VIVO. It's an award-winning B corporation with a global footprint spanning the UK, Australia, North America, Europe, the Middle East, and Southeast Asia, whose mission is to be the independent, trusted partner for sovereign nations that develop and operate sustainable data center infrastructure, ensuring sovereign control over power, data, and national intelligence. Happy to welcome its CEO, Kevin Chin, and CIO, Alex Cuppage. Welcome, gentlemen. We're looking forward to your presentation today. Kevin, whenever you're ready.
Many thanks, Anna. Great to be on. Thanks for inviting us. So Alex and I will tag team and walk through this presentation, which unpacks our strategy, our execution focus, and where we want to take the company. Okay, I'm just looking for the slides. Here we go. Can we see that? Okay, so just as a starting point, by way of background, VivoPower is headquartered in London. We founded in 2014. We've been NASDAQ listed since 2016, a B Corp since 2018. Pro forma revenues post a recent acquisition in Norway is approximately 31 million per annum. We are profitable on a run rate basis too, tracking that acquisition contributes north of 10 mil of EBITDA per annum. Fully diluted market cap at the moment is about 120 mil and enterprise value of about 140 mil. We have noticeable backing from sovereign family offices as well as a number of preeminent AI investors. That includes a member of the Saudi Arabian royal family, family offices associated with members of the Emirati royal family, Blue Sky Capital, who are rather one of the leading AI-focused investors out of New York, and the family office of a managing partner of a world-leading AI VC firm. Just in terms of summary, so what are we? We're a digital infrastructure company with access to and control over sub 5 cents per kilowatt hour powered land. We operate in very specific selected sovereign markets where we have deep connectivity. Our model is to acquire, develop, build, and own the AI-ready data center infrastructure assets delivered to powered shell level. So in essence, we're a bricks and mortar company exposed to the AI megatrend. The powered shells are leased to hyperscalers, to sovereign governments, to neoclouds, and enterprises under long-term rental agreements. And how we create value is in three ways. Number one is we permit and energize brownfield land. Number two is we make development profits. And number three, we make long-term rental income. Our land basis is typically ranging between 50,000 to 500,000 per megawatt, with sub 10 million per megawatt build costs and typical lead time to energization of 12 months. We actively avoid dilution by refinancing stabilized assets to release the development gains, which we recycle then to fund the equity tranche of future developments. And our development to refinancing capital cycle is typically 12 to 18 months, and our return on equity exceeds at least 2 times each turn. In our view, powered land is the most important strategic asset in the data center value chain, and hence our focus on this. We don't embrace GPUs as part of our business model. We don't take on, if you like, the technology risk associated with that, albeit we recognize it's a very lucrative game in terms of margins. That being said, we remain very focused on the bricks and mortar side, as I mentioned. Alex, would you like to add anything on this point on this slide?
My apologies, everyone. I've had to dial in. So Kev, just talk me through which slide you're on right now.
I'm sorry. Yeah, I know you've been in meetings. So this is the slide which shows the value chain with respect to the AI data center industry, and our focus is on the land and power or powered land side of things, and leasing out that to hyperscalers and sovereigns as a business model.
Yeah, I think everyone, and thank you for joining. We think the best value for shareholders on a unit economic basis is to own the power, which in very simple terms means, as Kevin said, we own the land at a very low basis. So we own it at 50 to 500K a megawatt. The true private market value is kind of greater than, more than $1 million a megawatt. And, when that's fully energized, we've delivered the end infrastructure, we should be able to rent that out between $1.2 to $1.5 million per megawatt. We are typically developing our data centers on an unlevered basis, somewhere between 12 to 16% yield on cost. If you compare that, say, to an office building, you're typically at somewhere between 5 to 7% yield on cost. So it's an incredibly profitable business model. Our end leases are typically anywhere between 15 to 25 years. So over the lifetime, this throws off significant free cash flow.
Thanks, Alex. So that's a good segue into the next slide. As Alex mentioned, we believe that's our sustainable competitive advantage, which is ownership and control of the land and the power connections associated with that land. As of today, we are focused on specific jurisdictions around the world. One is the Nordics, and in particular, Norway and Finland. Two is the GCC, and that encompasses the United Arab Emirates and Saudi Arabia. And thirdly, selected markets in Southeast Asia and North Asia. In all of these jurisdictions, as I sort of mentioned at the onset, one of the key criteria for us as to why we are focused on these markets is that we have, as a team, deep sovereign connectivity in those specific countries. We believe this is very important because over time, our view is that these assets become political footballs within the countries that they are operating, and that we need to engage and contribute back to the nations where we're building, owning, and operating these data centers. I talked about Norway at the onset, so that's already profitable site for us. We are looking to build that out further and to increase the yield on that through specific, AI activities and tenants. And similarly, we are building out the UAE as we speak as well. Finland is our big one, and again, that's live in terms of creating value.
Maybe just to add to that point, Kevin, so we are typically targeting regions where the power input cost is sub 5 cents kilowatt hour. To put that into context, that's roughly about a third of what most people in the US are the power input cost being. And we think over time, this gives us a very key strategic advantage. So when we've looked at operator models, for every cent increase in the power input cost, it can decrease an operator's margin by somewhere between 5 to 7%. So as AI becomes more pronounced within domestic and international economies, we think that everyone is going to start to focus on what is the power input cost, and that is going to be the most valuable asset in the long term.
Thanks, Alex. That's actually a good point. Just zooming in on the slide that's up at the moment. So, public markets ascribe premium valuations to power secured data center infrastructure. So the comparables, or the peers rather, trade, anywhere from 4 million per megawatt in terms of enterprise value to megawatts to north of 10 times. We are, literally just embarking on this journey where we're 5 months into the strategy. And so, obviously, aspire to create shareholder value and be benchmarked and valued in a similar sort of paradigm. As Alex was saying, powered megawatts is the scarce resource, and I think there's increasing recognition amongst industry players as well as the broader market that is indeed the choke point, not so much the GPUs. And that expansion of AI capacity and capabilities at the moment is fundamentally constrained by, number one, the availability of powered land with grid connection. Two is, again, as Alex mentioned, low-cost renewable power. So, if you were to actually, draw a Venn diagram of the world of where these sites are, there are very few locations where there's an overlap of powered land with grid connection, low-cost renewable power with zero to very low intermittency, if you will. Hydropower is particularly good in that regard. Thirdly, the ability to build within sort of an 18-month timeframe. Different markets have different regulations and structures or substructures with respect to resources, labor, rules, etc. And then there's also, cooling system limitations as well. So we believe what we've constructed so far in terms of portfolio and what we will continue to do so, meets these criteria. And hence what we'll end up with is an enduring portfolio of, very strategic long-term assets. As everyone knows, this next slide talks about hyperscalers and neoclouds drive most of the demand around the world. That's certainly what we're seeing in terms of engagement, in terms of interest. Ex post our closing of the Norway deal a few weeks back, we've fielded a lot of inbound interest with respect to that site from various players in the AI industry. So that's a core focus for us to cement the best deal in terms of counterparty and tenants that will materially boost our revenues and EBITDA going forward. So what we fundamentally are, just coming back to the unit level economics, if you will. So we are a bricks and mortar business, albeit a growth one, with a very high reinvestment rate of return. So the flywheel we want to get to is, as I mentioned before, we build an asset. Once it's stabilized and generating yield, we refinance. We're able to draw down the capital gain on that and reinvest that as part of the equity check or financing check for the next development. And with each turn of that, which takes 12 to 18 months, we should be able to compound and build an increasing pool of capital and cash, and along the way, really try to sort of obviate the need to raise money from the markets, which we are sort of very careful about and very focused on to sort of avoid dilution.
Maybe, Kev, if I may, just to build on that point. So what we wanted to do here was create a very sustainable business model that provides a sufficient funding model to keep building out the portfolio of powered land that we have. We're able to do that because we take greenfield, brownfield lands, we energize that land, we get it permitted for data centers, and as Kevin mentioned, we hold that land on our balance sheet of 50 to 500K a megawatt, which gives us an incredibly low basis going into a development. And our business model is never to take cash out, but to roll that equity into future developments. So the simple way of looking at it is for every dollar development equity that we put in over 18 to 24 months, we turn that dollar into $1.50 to $2 of recycled equity, which we continue to build a portfolio with. And for every dollar of development equity, we generate somewhere between $2 to $5 of book value equity gain. So it's an incredibly sustainable business model, which we have not seen elsewhere.
Actually, just to add to that, the core team for VivoPower on this business collectively have had many years of development experience, if you will, across multiple asset classes, both from an investment perspective as well as from an operational perspective. Spanning commercial real estate, residential real estate, shopping centers, toll roads, airports, data centers, cloud data centers, historically, industrial REITs when they were in their growth phase, 20 years ago. And the returns we're seeing from this particular field, far outweigh anything that we've seen before, to Alex's point. And just to, zoom in again on a specific example, which this slide shows. So if we have 100 megawatts to build, we're talking about, CapEx order of magnitude, 8 to 900 million for that. Typically, you can finance that with 80 to 90% development debt, comprising both senior as well as mezzanine, and the residuals, the equity. Typical lease rates on a triple net basis are about 130 US thousand per kilowatt per month. So we're typically looking at an unlevered yield on the asset of 15 to 16%. And once that's stabilized, as in built and rent is flowing, that can be refinanced at a cap rate of 6 to 6.5%. So in this specific example, that unlocks significant development gain north of $1 billion, and we could pull out about 750 mil to recycle into the next series of data centers to be built. Alex, anything I missed there?
No, I think that's great, Kev. I think just to really highlight what we mean by recycling the capital. It's really a mindset that we are taking a very long-term view to delivering a very high return on asset cash flow basis over the long term and to be sustainable. And I think it's not rocket science, but a lot of this industry is driven by a private equity mindset, which is to strip out as much profit as possible over the short term, whereas what we focus on is using those gains to keep building the portfolio in a very sustainable manner where we just do not have to go back to the market. And we think that's the best way forward to building a large-scale portfolio of cash flows underwritten by hyperscalers and sovereign cloud providers.
Thanks, Alex. So just on the next couple of slides, we'll just talk to the market a bit. So one of the reasons we are focused on non-US markets is that the landscape is far less competitive. One, two is we're also very focused on being neutral. So the Europe and the GCC are attractive in that regard. And that's not all countries in Europe or the GCC. It's very specific and very focused, as I mentioned. And they both exhibit materially higher unmet demand versus what's available from a sort of powered land capacity perspective relative to other markets. And as Alex mentioned before, the cost profile from a competitive standpoint is a lot better. And we're able to benefit from the Rolodex of investors and relationships that we have in these markets. And as mentioned, specific Asian markets are also a focus, for us going forward. The Nordics are particularly attractive at the moment, and they outperform established hubs for power costs, as well as for the speed of grid connection. In some markets in mainstream Europe, if you will, lead times for interconnect agreements have, blown out to 5, if not 10 years. Similar to what's happening in sort of parts of the US, including Texas. So the Nordics don't, have that at the moment. It's a lot quicker to get grid connectivity, and power cost is attractive. Obviously, cold climates is conducive to lower cooling costs as well. In the GCC, what's particularly appealing to us about that market is that there is very strong government-driven support and investment for AI data centers. They see it very much as a key plank for sovereign prosperity going forward and competitiveness, and there's very little friction, by way of political sort of resistance, if you like, and societal resistance as well, to data centers. Obviously a lot of land, a lot of cheap power as well in these markets. So we have a very clear 10-year strategic growth plan, which spans 3 growth horizons. So the first one, which we're in now between 26 to 2029, is to secure 100% control of 2 gigawatts of power across our focus markets to generate over $1 billion of revenues and north of 200 million of annual operating free cash flow from rental income. Then as we transition to phase 2, which is 2030, 2033, we want to sort of build up further on that, and again into stage 3, where the remit there will be to build or transition to an autonomous global infrastructure network, where in total we have more than 20 gigawatts and generating north of 5 billion of revenues. So that's what we're all shooting towards. And then last but not least, just to quickly go through the team, there's myself, but sort of very much see this as a partnership, if you will, of the team that's profiled on this page, as well as the advisory council and the board on the next page. So Alex, Chief Investment Officer; Shane, Chief Real Estate Officer. He is based in Dublin and has long-standing relationships with all the hyperscalers, including Google, Microsoft, Amazon, and has done, a lot of development over the last, 20 years across, multiple asset classes. We have Owen Elliott, who's head of development and delivery, worked on multi-billion-dollar projects around the world, and including power construction and delivery, and echelon data centers, and highly experienced operative, been extremely valuable to us already as we look to build value across our portfolio. And finally, last but not least, we're blessed to have some great advisory council members and board members, notable ones rather on this deck for this strategy. We have Khadija Mustafa, so she's ex-Microsoft Global AI Sales Head. She was there for 20 plus years. Philip van Wolfen, who found and originated the Finland sites, and was the former co-founder of the JAB Consumer Fund, which was the fastest growing private fund in Europe. It was the largest first-time fund, I should say, in Europe. Left that to focus on this, given what he sees coming with respect to the very strong tailwinds and opportunity for AI data centers. We have Rachel in the Middle East, ex-Mubadala, the Sovereign Wealth Fund there, and Hugh Durant-White, who is one of the foremost AI and automation experts in the world, formerly Chief Scientist for the Ministry of Defense. So active board and advisory council that's really helping us as we scale this business and execute on the growth plan and strategy that we've articulated. Thank you all for joining. Thank you, Alex, for jumping on.
Thank you, gentlemen. Thank you, Alex. Thank you, Kevin, for this great presentation. Great way to end our conference today. We appreciate you both, and we certainly hope to follow along with you in the near future. Thank you, gentlemen.
Thank you, Anna.
Thank you, everyone.
Thank you, Ryan.
All right. Thank you all to our viewers for watching. It completes day one of our virtual conference. We'll see you back here tomorrow, bright and early at 9 a.m. Eastern for day 2 of our virtual investor conference. Thanks, everyone, for watching. We'll see you tomorrow.